So, and within these high growth companies, many of them might be profitable and successful in the future. So, how can we actually find value in these high growth companies, considering that sometimes they do not even have a profit? So, sometimes their free cash flow will be negative. And a lot of people say that GCF models aren't the best tool anymore to value them. So, what's your opinion about it?
First, separate that into two parts. It's not even if you're a young growth company, your cash flows are going to be negative. It's a feature, not a bug. You know why your cash flows are negative? Even if you're making money, you're reinvesting huge amounts to get future growth. Negative cash flows are a feature at young companies and not a bug. It means nothing in terms of what the value of these companies is. The greatest companies, you see these trillion-dollar companies that you see out there, at one point in time used to be money-losing negative cash flow companies. So first, let's separate what value is from what the cash flows look like right now. You could have a negative cash flow company, which has a huge value. You could have a positive cash flow company that's not worth much. But to decide whether to invest in something, it's not just the value that matters, right? You have to look at the price. I say something that drives people crazy. I say, look, at the right price, I will buy any company. And I mean what I say. You give me a young, high growth company with lots of potential. Zoom. Zoom is one of those companies that has taken off over the last year because everybody's on Zoom. I think Zoom is a great company, immense potential. In fact, I think its value has tripled over the last year, but I wouldn't touch the company with a 10-foot pole. You know why? Because the price has gone up tenfold. I think it's overpriced. It's a great company that's overpriced. In contrast, you give me a company like Philip Morris, boring company, not doing well. It's a tobacco company. People are smoking less. But its price is lower than its value. The story I'm telling for Philip Morris is not a great story. It's going to have negative growth. Its cash flows are going to decrease over time, but it's selling at the right price. Any discussion of investing has to bring in the price into the equation. I mean, I hear people, especially among the value investing community, say, look, just buy a great company, a well-managed company. That's all you need to do. And I think that's very bad advice. If you invest in a well-managed company that everybody else also realizes well-managed, you know what's going to happen? The price is going to get pushed up. Your best odds might actually be badly managed companies where people have given up. You get it at the right price and you hope the management gets fixed. So we need to separate our discussion of what makes companies great from what makes investments great. It's a very different discussion because the former is driven by how well is the company run, how well is it managed. The latter is driven by what's the price relative to the value.